All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Wednesday, everybody. Today is Wednesday, September 11th, 2024. Happy Inflation Day, and that is the top story. We got the Consumer Price Index just a few minutes ago, and this one was a little hard to interpret. I'm not going to lie. The headline number probably getting all the attention, a little bit below expectations. We got 2.5% year over year headline inflation. That's a big drop from last month. We were 2.9% last month. So a big step down in headline inflation. It was below expectations. The market was expecting 2.6. They got 2.5. So it's a lower inflation print. Is it that much lower? Is it enough for 50 basis points? Probably not. But wait, there's more, month over month. Flat, roughly in line. 0.2% month over month inflation, exactly what the market was expecting, exactly what we got last month. So on a monthly basis, there's no change in headline, but it gets complicated further. Core inflation also exactly flat, exactly where expected. We got 3.2% year over year core inflation. That strips out volatile food and energy. Market was expecting 3.2%, and we were 3.2% last month. So there's no change to the headline year over year core, to the core year over year number. But then we got one little caveat, one little asterisk attached to this inflation print, and that's core inflation on a month over month basis. That came in at 0.3% month over month. That is higher than the 0.2% that's expected, and it's up from 0.2% last month. So core inflation on a monthly basis, slightly higher. Headline inflation on a year-over-year basis, slightly lower. That leaves this inflation print very much open to interpretation as to, was it a good read or was it a bad read? If you want to say, yeah, inflation is lower, the Fed over-tightened, you can point to that 2.5%, the big drop from 2.9, and you can say, see, the Fed is over-tightened, give me 50. Or if you're one of the people who's saying inflation is sticky, you can point to that core and you could say, see, core isn't coming down. This was really just a move in oil prices that's being reflected in the headline number, and there's really no decline in inflation. So depending on your pre-existing biases, you could probably make whichever argument you want to make right now. Here's the main takeaway from my vantage point. 50 basis points is off the table at the September meeting. And I think that is what's driving this reaction in the market this morning. And it's pretty interesting to watch. Initially, we saw stocks sell off a little bit on this inflation print. I think that was the market pricing out 50 basis points. But then we got a strengthening of the dollar. The Dixie shot higher. And we saw the yen weaken. And that's interesting because the yen was strengthening yesterday. And we saw tech stocks were down pretty big this morning at one point because it looked like we may be getting back into that Japan carry trade unwind. Then we get this inflation print that takes 50 basis points off the table. The market sells off a little bit. Oh, I'm not going to get my ZERP from the Fed. But then the dollar starts to strengthen based on those expectations of a less aggressive Fed, and that drives the yen lower. And now it looks like people might be putting their carry trades back on, and they're bidding up tech stocks. So the NASDAQ is rallying a little bit off of this news. So it's really hard to interpret this move today based off of inflation. But the one takeaway, I think, is that 50 basis points for September is now off the table. This was really the last data point. So barring like a bank just blowing up, let's not take that off the table. Ally Financial yesterday down 18%. Check out the video I did on that one yesterday if you want. I got a link down below in the description if you're on YouTube watching this one. But really 50 basis points is the only takeaway from this inflation. Also going on this morning, we got Samsung is announcing layoffs. 30% of their administrative staff globally is about to get laid off, and 15% of their sales and marketing staff is getting laid off. So this is leaked information from unnamed sources, so you got to take that with a grain of salt. But Samsung has been struggling. They've been lagging the other consumer electronics and the other chips names. Both sectors have really been hurting. So no word from the company. Anonymous sources are saying this is the company preparing for a global recession and a slowdown in demand for consumer electronics. Maybe they'll try to spin this as saying, oh, we're just going to replace all our salespeople with AI like all the other companies are doing. But more job losses, more recessionary talk from Samsung this morning. We also got some interesting quotes from JP Morgan yesterday. First, their CFO was talking about how you can expect lower net interest income in the coming months, that they think that analysts were being a little too aggressive with the estimates of how much interest income the bank was going to make, especially in light of pending Fed rate cuts. And so that sent the stock a little bit lower. We also got comments from Jamie Dimon yesterday, who was talking about stagflation worries, which he refused to take stagflation off the table. So those two comments combined sent JP Morgan stock down about 5% yesterday. At one point, JP Morgan was down 7%. That's one of the biggest banks in the world moving like that. That's a very volatile move in JP Morgan. So the financial stocks across the board were just a mess yesterday. I don't know how much of this could be attributed to these comments by JP Morgan or these new Basel III regulations that are expected to be rolled out any day now, although they've been watered down pretty substantially. Or maybe it was that Ally Financial story about people not making their car payments, really worrying people about a recession. Whatever it was, financial stocks got bludgeoned yesterday across the board. Also, Ford and GM were dragged down by that Ally Financial story as well. Again, link down below in the description if you're watching on YouTube for that Ally video. GameStop reported earnings after the bell last night. The stock is getting hammered this morning, down 12%. The company did post a surprise profit, but revenue was a miss, so GameStop is selling off here. Mortgage rates down 14 basis points last week. Big decline to 6.29%. The average mortgage rate in this country continues to fall ahead of these Federal Reserve rate cuts that have been expected. That is the lowest mortgage rate since February of 2023, and yet no reaction from the real estate market. Despite a 14 basis point drop in mortgage rates, we only saw mortgage applications increase by 1.4% for the week, barely budging. Refis up just 1.0%. So the real estate market remains frozen in place, guys. It's not about mortgage rates. People need lower prices. There is no cash left in the bank for young potential home buyers. If they did have cash saved up for a down payment on a house, inflation has eroded that away. And so mortgage market, the real estate market just remains frozen in place. And last but not least, we have to talk about it. I hate to talk about politics, but we got to get into it. The presidential debate was last night, and I watched about the first hour before I had to turn it off. I couldn't take any more. Sorry, guys. I wanted to watch the whole thing to be able to comment on the whole thing. But after an hour, I switched it off. I had better things to do, like bite my fingernails or who knows, whatever. Just like anything but watch more of that. So here is my takeaways from the presidential debate last night. Kamala Harris is fake and disingenuous. There is not a legitimate, genuine bone in that cackling buffoon's body. She did not answer any questions that were asked of her. Donald Trump was easily baited because the man can't control his ego. And so instead of sticking to policy and substance questions, he allowed himself to be manipulated by Kamala Harris, who made some stupid quip about people leaving his rallies early. And Trump wasted almost 2 minutes talking about the wonderful attendance at his rallies when he should have been talking about policy. That was an easy layup that Trump missed. At times, Trump was just rambling and incoherent. So both candidates, terrible showing last night. The worst showing by far was from ABC News, who I believe still considers themselves to be a journalistic organization, even though they spiked the Epstein story because of threats from Buckingham Palace. Remember that one? Yeah, ABC. I haven't forgot about that one. But what a disgrace. The moderators, both of them routinely fact-checking Donald Trump and arguing with him. Your job is to ask questions, not to argue with one of the candidates. I didn't get out a stopwatch and actually go back, but in the first hour of the debate, there was at least 5 minutes that was not Trump debating Harris. It was Trump debating the moderator. So, hey, it was a 3-on-1 debate. ABC News, what a freaking disgrace to journalism. Although we already knew ABC News was a disgrace to journalism. Nothing new there. And last but not least, spending. Where was the discussion of spending? Maybe in the 15 minutes that was left before I had to turn it off, maybe they donated a few measly seconds to spending cuts. But in the first hour, I did not hear one question or one policy proposal about how they might cut spending. And guys, spending out of control in D.C. and the enablers at the Federal Reserve is the single biggest threat to United States supremacy and hegemony around the world. And it was not even on the table yesterday. They were talking about freaking in vitro fertilization, the pressing issue of our time, in vitro fertilization, or gender reassignment surgeries for illegal immigrants. That was discussed, but not cutting spending for a country that's, 35 trillion in debt? Are we 36 yet? What time is it? I think 36 is lunchtime today. Didn't even talk about spending cuts. So who won the debate yesterday? Nobody. Everybody lost. The civilized world lost. Both candidates are a disgrace. The moderators were a disgrace. They talked about the wrong things. That is my takeaway. Last but not least, I'll just mention from an electoral standpoint or from a political standpoint, the one takeaway, DJT stock, Trump media, is down 14% this morning. That stock is getting hammered. In my opinion, that's people voting their wallets saying they think Kamala came out on top in the debate yesterday. And based on what I saw, if I had to assign a winner, I would probably assign it to Kamala as well. But again, I think it was just a horrible showing by everybody involved. And with that, let's shrink my big melon of a head and let's see what's going on in markets this morning, shall we? Don't forget that thumbs up button and that subscribe button if you're new here, because we do this every day. So come have your coffee with the melon heads. Right now, though, the S&P 500 is down 1.7 points. Barely moving this morning. You can see we had that sell-off initially on the lower than expected CPI print, and I think it's just the fact that it wasn't low enough to cement the 50 basis point cut expectations that stocks initially sold off, but they have clawed back and are now threatening to go positive. At least that is the S&P 500. The Dow, meanwhile, is down 134 points here, pretty deep in the negative here, 0.32% lower. Big sell-off on the CPI announcement, clawed back some of that, essentially right back to where we were prior to the inflation announcement. And the NASDAQ is actually going positive here. This is interesting. The NASDAQ is up 45 points, 0.25% higher. We got the Dow and the S&P are negative, but the NASDAQ is rallying. Put a pin in that NASDAQ. I think I know what might be going on here. And it has to do with the DXY, or the US dollar, 101.69. It's up 6 basis points. The dollar was weaker, considerably weaker this morning on a strengthening yen in Japan last night. And then we got the inflation print, and it looks like 50 basis points was taken off the table, and we saw the dollar surge. What did we go? We went as high as 101.81 from 101.41. So we saw a 40 basis point move stronger in the dollar at some point off of that inflation print. And I think that's got something to do with why that NASDAQ is rallying, because take a look at the Japanese yen. We were as low as 140, 140.8 a couple of minutes ago. Now we're at 142.2. So the yen has actually weakened substantially, even though it's a little stronger than it was this time yesterday. Here, let me switch this to, we'll do 5-minute candles and maybe you can see it. Here we go. All right, we saw the yen strengthening all last night. And then here we go. Here is the inflation print this morning. And we saw a significant weakening of the yen right on that inflation print. And it actually weakened quite a bit. We were at 141.7 and we went as high as 142.5. Remember, as you see this chart moving higher, that's the yen weakening. So the inflation print weakened the yen substantially because the dollar got stronger, and now we're seeing the NASDAQ rally. In my opinion, the fact that 50 basis points is now off the table has strengthened the dollar, because the dollar was pricing in a chance of a 50 basis point rate cut. That strengthening of the dollar has weakened the yen, and people are putting their carry trades back on, and that's why we're seeing the NASDAQ rally this morning. That's just my interpretation of what these tea leaves are saying. Let me know what you think is going on. Why is that NASDAQ surging this morning? Maybe it's got something to do with this NVIDIA conference that's going on today, maybe not. But some unusual price action in the NASDAQ this morning, to say the least. Also, furthering expectations, or furthering my belief that 50 basis points is now off the table, we've got yields are moving higher pretty much across the board this morning. The 30-year Treasury, 3.976. That's up 2 points and change. The 10 years at 3.676. That's up 3 points. All of these were negative before the inflation print, by the way. The 2 years at 3.662. That's up 5.5 points here. And the 1 month at 5.09. We had a big move down in the last couple of days here in the 1 month Treasury, heading back towards 5%, although it was 5.05 before that inflation print. Now it's up a couple of basis points here. The 10-2 inversion, by the way, or uninversion, down to 1 point. So we got the yield curve is flattening a little bit here, threatening to reinvert. That's interesting. And looking over at commodities, we've got gold, spot gold at $2,510. That's down about $6.40 here, 0.25% lower. Spot silver at $28.59. That's up 19 cents or 0.69% higher. We've got coppers up by about 1.1%. Platinum is flat. Palladium is up 2.4%. And WTI crude is up 1.86%, $1.22 higher for West Texas Intermediate here. Now, let's talk about crude because we have got a hurricane barreling towards Louisiana and Texas right now. This is the projected path of, right now, I believe it's still a tropical storm, but Francine is expected to be a Category 1 or 2 when it makes landfall. This is the Gulf Coast. You can see here these color lines here. That's showing the Gulf Coast. And all of these brown dots are oil rigs or oil platforms. And you can see there's several hundred oil platforms in the path of this hurricane. Those have all been shut in and partially evacuated. And just to the east, there's a whole bunch more. So we're looking at about 20 to 25% of Gulf Coast oil production has been disrupted by this storm. Means we're probably going to get some volatile oil inventory numbers over the next few weeks. That's something to keep an eye on, possibly contributing to those higher oil prices this morning. Meanwhile, we got Bitcoin at $57,065. It's up a little bit from yesterday, but it's showing as negative here, down $550 on Coinbase. Still trading in this mid-50s range that Bitcoin has been in for quite a while. Not a lot of movement in the Bitcoin space. Now let's talk inflation, shall we? Here is the chart of your headline year-over-year inflation rate. And you can see here, we have been falling pretty steadily. You know, earlier the year, we had people were worried about the second wave of inflation, especially around March when we got that 3.5% number. Higher for longer was all the rage. And we have fallen kind of steadily ever since. And now it's starting to accelerate a little bit. Big step change down in that headline number, 2.5%, coming in below the 2.6% expected and well below last month. So that is the good news, if you will, in the CPI, the lower inflation there in the headline number. Month over month, the headline number was pretty much unchanged and in line, 0.2%, exactly where we were last month, exactly as expected. So the month over month headline number was really a no, never mind. Same thing with the year over year core inflation number, roughly in line, 3.2%, exactly what was expected, exactly where we were last month. Now, this is kind of showing, yeah, we've been taking our time. Core inflation has been coming down a lot slower than headline inflation. So more of that. But this was the data point that has everybody kind of scratching their heads. While that headline year over year number came in lower than expected, that core month over month number came in higher than expected. And remember, core takes out the volatile commodity stuff, the food and energy. So this is a more accurate reflection of what the base prices are doing. Now, the interesting thing in this core number, 0.3%, higher than expected, higher than last month, almost all of this was housing. And that's the thing here. Housing is a lagging indicator. But you know what, guys? Housing didn't get any better last month. Housing actually got worse last month. And it's just making me wonder what is going on with these shelter costs. So let's take a look here. Let's look at the chart. This is the actual CPI release. This is the attachment from the BLS.gov website. Here is your headline year-over-year number, 2.5% up in this corner. There's your month-over-month headline number, 0.2%. We had food inflation was 2.1% year-over-year. The monthly number was down from July at 0.1% versus 0.2%. Food away from home was flat, no change there, 0.9% year-over-year. So restaurants didn't get any more expensive last month. Food away from home. My bad. Food at home was flat, unchanged. So little relief at the supermarket, if you will. Food away from home got more expensive, 0.3% versus 0.2%, still up 4% year over year. So restaurants are getting more expensive. I think that's probably being driven by labor costs more than anything. The energy index, negative 4% year over year, negative 0.8% month over month. Negative virtually across the board. Only electricity and pipe gas was a little bit more expensive in the month, but energy was a big drag on CPI. It took it lower. Now let's get into all items, less food and energy. Your core numbers, there's your 3.2% year over year and your 0.3% month over month. New vehicles were unchanged for the month. That was interesting. We have seen several consecutive months of negative numbers for new vehicles. And now we've got no change this month, still negative 1.2% year over year, but new vehicles took a break from price declines. Possible some of that slowing production is having something to do with that, although inventory is still a drag on all of these car dealerships. Used cars and trucks were down again, but down less than prior months. We had a negative 10.4% year over year number. So used vehicles getting cheaper big time. That's partially contributing to those big losses at Ally Financial that we heard about yesterday. The big decline in car prices means when people don't make their payments, and Ally Financial sends the repo man out to repossess the car to recover money from the loan, well, they're selling a car that's worth a lot less than when they made the loan for it. And so the losses are piling up at Ally Financial. Once again, link down below if you want to check out that video from yesterday. But the month-over-month decline in used vehicles, used cars and trucks, that was a lot lower than it's been in prior months. Negative 1% versus negative 2.3%. So still falling pretty fast, but it's slowing dramatically there. I'm not sure what to take away from that slowdown in price falling in used cars. I don't really think there's a big surge in demand for cars that's causing that. We've got apparel was up 0.3% for the month and for the year. Medical care commodities swung from positive 0.2 to negative 0.2, still up 2% for the year. Now, the shelter index, guys, that's a big one here. The shelter index, 0.5% for the month. That's actually up from 0.4% in July. And the year-over-year number at 5.2%, that's up from 5% last month. So the shelter index is heading in the wrong direction. It's being led by owner's equivalent rent. We still are not seeing these shelter costs come down. It's taking forever. This thing has been lagging. Normally, the lag is just a couple of months. We're looking at like a year and a half right now when you would typically expect to see these shelter costs coming down. So I don't know, is this just more flaws in the methodology, in the gathering of data points, or are we still seeing asking rents rising across the country or in some key markets? It's hard to rectify the differences in price action that we're seeing in the Northeast and in the Great Lakes versus what we're seeing in the Sun Belt, where you're seeing prices start to fall pretty dramatically. But for whatever reason, shelter will not come down. It's actually rising faster. And almost the entirety of this increase in core CPI is being driven by shelter. So that's one to keep an eye on, and that's another head scratcher. Again, it's really hard to take anything away from this inflation print other than the fact that 50 basis points is probably off the table here. Also, we got transportation services accelerating here from 0.4 to 0.9. That's being driven by airline fares and auto insurance. Those are the two categories in transportation services that are bringing that cost up. So that is still rising faster. And rounding out the list, medical care was down 0.1% versus 0.3% in the month prior for a 3.2% annual increase. So, let me know, guys, is there something hiding in this data that you think I'm missing? Is there something in the chart that jumped out at you? The slowdown in used vehicle prices collapsing, the stubbornly high shelter costs. Other than that, there's not a lot of big surprises in this report here. So let's shift gears a little bit to this Samsung story. Samsung Electronics plans global job cuts of up to 30% in some divisions. This one is in Reuters just this morning. Samsung Electronics, the world's top maker of smartphones, TVs, and memory chips, is cutting up to 30% of its overseas staff at some divisions. Three sources with direct knowledge of the matter told Reuters. South Korea's based Samsung has instructed subsidiaries worldwide to reduce sales and marketing staff by about 15% and administrative staff by up to 30%, two of the sources said. So these companies employ about 240,000 people. It's believed that these job cuts are going to number somewhere around 1,000, maybe 2,000. Now, one of the sources familiar with the plan said that the job cuts were being made in preparation for a slowdown in global demand for technology products as the global economy slows. Another source said Samsung is seeking to shore up its bottom line by saving on costs. So this is a very recessionary story here. We're seeing them downsizing their office staff, anticipating a slowdown in demand. Samsung stock was down almost 2% yesterday. This is priced in Korean won, 64,900 won per share, down about 2% for Samsung. Also going on this morning, yesterday anyway, we got two stories from JP Morgan that contributed to that sell-off in financials yesterday. JP Morgan Chase shares dropped 5% after bank tempers guidance on interest income and expenses. JP Morgan Chase shares fell 5% on Tuesday after the bank's president told analysts that expectations for net interest income and expenses in 2025 were too optimistic. While the bank expects to be in the ballpark of the 2024 target for net interest income around $91.5 billion, the current estimate for next year of about $90 billion is not very reasonable because the Federal Reserve will cut interest rates, JPM President Daniel Pinto said at a financial conference. I think that number will be lower, Pinto said, and he declined to give a specific figure. So we had their president warning about lower net interest income. And then on the same day, we had this quote from Jamie Dimon, who says the worst outcome is stagflation, a scenario he's not taking off the table. JP Morgan CEO Jamie Dimon said on Tuesday that he wouldn't rule out stagflation, even with greater confidence recently that inflation is coming off of its highs. Dimon's quoted as saying, I would say the worst outcome is stagflation, recession, and higher inflation. Dimon said at a fall conference from the Council of Institutional Investors in Brooklyn, New York. And by the way, I wouldn't take it off the table. Now, Jamie Dimon has made some pretty alarmist statements in the press over the last few years, right? This time last year, he said a financial storm is coming, the likes of which the world has never seen. So he's a little bit known for alarmist rhetoric as it is. But the stagflation word, that's kind of a buzzy word, and the market was paying attention. So it was either that or the net interest income story or the Ally Financial story sent JP Morgan stock down 5.2% yesterday, although it's up a couple of pennies this morning, trading at $205.69. But financials across the board just got beaten up yesterday. Consumer financials, banks, regional banks, New York Community Bank, Affirm, FinTech was down, Ford and GM were down. So it was really hard to tell what was really driving the story in banks yesterday. And you had a strengthening yen going on at the same time. So it was really hard to interpret that data yesterday as well. Shifting gears to meme stocks here. GameStop stock tumbles despite the surprise profit in earnings. This is why GameStop stock plummeted in pre-market trading on Wednesday after reporting earnings that beat expectations, but sales that fell short of analysts' forecasts for its fiscal second quarter. More than its quarterly results, investors were looking for signs of growth from the video game company. GameStop reported earnings of 4 cents a share on sales of $798 million. Analysts had expected a loss of 9 cents a share, so that was a big surprise in profit. That was good. But analysts were expecting sales of $896 million, so it was a big miss on revenue. It looks like it's that revenue miss that's really driving the narrative for GameStop down. Is the market open yet? Market just opened, down about 11%, trading at $20.89, $2.57 lower today. Also going on this morning, we got the 30-year mortgage rate for the United States. Fixed rate mortgages with conforming loan balances declined by 14 basis points to 6.29% for the week ended September 6, 2024, reaching the lowest level since February of 2023, according to the Mortgage Bankers Association. And this chart shows it, guys. Mortgage rates peaked last October at 7.9%. They fell dramatically last fall. They recovered a little bit through April on the worries of resurgent inflation, and now they are falling dramatically once again. So a big time decline. Look where we were a year ago, down almost 1.5%, 1.7% from where we were a year ago. And yet it's having no measurable impact on the real estate market. That's the crazy thing about this. Mortgage applications in the U.S. rose just 1.4% in the week ending September 6th. Following a 1.6% increase in the previous period. Data from the Mortgage Bankers Association showed applications to buy a home advanced 2%, while those to refinance a home loan were up 1%. And so you can kind of see here, guys, there's really no noticeable change, just standard noise in the charts here. 1% increases, 2% increases in applications and refis. The real estate market will not budge even on these lower rates. So what is that telling you? It's telling you these rate cuts at the Fed, they don't matter. They're not going to change the story in real estate. We need lower prices. Home prices need to fall dramatically to bring buyers back to the table, and they're just not letting it. They just won't let these home prices fall. We're hearing all these cockamamie proposals out of Washington about pumping more taxpayer money into the economy in order to support higher home prices, or they're saying home down payment assistance, but it's just pumping more money to chase the same number of houses, which is going to drive prices higher. In Chicago, they're talking about a taxpayer-funded bailout to give people money so they can afford to pay their property taxes. What? Why don't you just lower the property taxes instead of giving people money so they can pay them? It's the same net effect. Oh, but lower taxes in Chicago. We can't do that. All of these stupid things that are being proposed in real estate, just let the prices fall. The prices want to fall. Just get out of their way. Entire generations have been priced out of the housing market. Let them back in. It's the only way to fix this broken real estate market. But you know what? That is not even on the table, much like spending cuts that weren't even discussed yesterday in the presidential debate. They're just not having it, guys. There's just nobody talking about spending cuts. And that's a sad reality. Again, we're going to end on a little bit of a political note here. The single greatest threat to this country, to its hegemony, to its dominance on the world stage, both economically and militarily, the single greatest threat to this country is the runaway spending in Congress and the central bankers at the Federal Reserve, who are enabling it by debasing the currency. It's created the inflation that has crushed the life of the average American in the last few years. And it's not even talked about. They're talking about stupid topics in these debates. They're talking about divisive issues like gender, like race, like in vitro fertilization. Why did that even come up last night? Nobody is even talking about spending. Between the lack of quality in the candidates, the lack of quality among the moderators in the debate, I think that debate last night had more to say about us as a society and as a civilization than it did about anybody who actually participated in it. We need higher standards, folks. This petty BS needs to stop. And that is all I have for you this morning. Thank you so much, everybody, for having your coffee with the Melonheads. Oh, you did it. Grandpa, cut the music. Grandpa did it. You know what? I was about to sign off, and you dropped that stealth super chat right as I hit the music. Keynesian economics. It's the systemic issue that isn't being addressed. I agree. Keynesian economics is it the root of the problem? I don't know. Maybe that's why, because we only teach Keynesian economics in our education system. So to hammer, everything looks like nails. And every time things go a little bit bad economically, the Keynesian response is increase government spending to offset a decline in the credit cycle, instead of just letting the ship right itself like the Austrians would do. And then we wonder, why are we $35 trillion in debt? I agree. Keynesian economics is the problem. It is systemic. Lack of quality education and finance at every level of education. And thank you so much, Grandpa, for the super chat and for the support of the channel at the end there. Very sneaky, sir. You are very sneaky putting that in there right as the music plays. And with that, we're going to wrap this one up. Thank you again, everybody, for having your coffee with the Melonheads. Thank you, Grandpa, for the super chat, the support of the channel. Thank you to my magnanimous Melonhead members on YouTube and Patreon for supporting the channel. Looking forward to talking to you guys tonight at 6 p.m. Eastern Time for our weekly get-together on Zoom. Links down below should you feel so inclined, along with that video about Ally Financial from yesterday. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.